You spent years building a portfolio of individual stocks, believing that holding dozens of companies was true diversification. But in a taxable account, this strategy often acts as a hidden tax on your performance, creating an administrative nightmare that erodes returns over time without you even realizing it. Today, we expose the mechanics of this cost basis trap and explain why moving away from fragmented holdings is one of the most powerful financial decisions you can make for your future wealth. The confusion many investors face stems from a fundamental misunderstanding of what diversification actually costs in real-world terms when held outside of tax-advantaged accounts like an IRA or 401k. We are told that owning 50 different companies spreads risk, and while this is true regarding market volatility, it introduces a severe administrative burden known as the cost basis tracking problem. The Internal Revenue Service allows for specific share identification, meaning you can choose which exact shares to sell when deciding whether to realize a gain or loss. However, in practice, managing dozens of individual stocks creates a fragmented landscape where hundreds of separate transactions must be tracked with precision over decades. This complexity forces most investors into reliance on the first-in, first-out rule by default because tracking every lot becomes cognitively impossible. This default mechanism creates a significant tax drag that locks high-cost shares in your portfolio for years while you sell off lower basis winners first, triggering unnecessary capital gains taxes earlier than necessary. The result is a hidden inefficiency where compounding works against you rather than with you. While the IRS guidelines confirm that stock splits require lot-by-lot basis adjustments and specific identification is permitted, the practical reality for investors holding dozens of individual stocks is a severe administrative burden that often forces reliance on this suboptimal default rule. This structural inefficiency acts as a hidden drag on returns that advisors frequently overlook when recommending concentrated individual stock portfolios over tax-advantaged vehicles or broad exchange-traded funds. The core evidence supporting the reframing of diversification as a hidden tax lies in these mechanics. While specific share identification is theoretically possible, the administrative overhead leads to suboptimal harvesting where investors fail to harvest losses on underperformers due to the cognitive load of managing hundreds of lot-level transactions. Essentially, you are leaving free money on the table because tracking every single position becomes too difficult to manage effectively over a long investment horizon. Quick resource note. I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. Unlike a single fund where the manager handles internal tax efficiency and wash sale avoidance through automatic rebalancing, a portfolio of individual stocks exposes the investor to what we call tax lot mismatching. This occurs when you sell a specific high-basis stock simply because it has underperformed or is no longer part of your thesis, triggering unnecessary short-term capital gains that a consolidated vehicle would avoid entirely. The difference between selling one unit of an index fund and selling 20 different individual stocks can be the difference between paying zero taxes on rebalancing versus paying thousands in immediate tax liabilities every single year you attempt to manage the portfolio yourself. The statistics behind this phenomenon reveal just how significant these hidden costs become over time. When investors hold many individual stocks, they create a fragmented cost-basis landscape that forces them to realize capital gains incrementally upon selling winners, converting what should be tax-deferred compounding into an immediate tax drag that erodes long-term compound annual growth rates significantly more than standard fund fees ever could. This is not just about paying higher taxes, it is about the opportunity cost of those tax dollars never being reinvested to generate their own returns over a 30 or 40-year period. Furthermore, without specific adoption data quantifying the magnitude of this drag compared to standard ETF fees, we must qualify that while the tax drag is a real structural inefficiency inherent to fragmented taxable portfolios, its financial significance varies drastically based on your holding period and the volatility of the underlying assets you hold. However, for the vast majority of long-term investors who do not have dedicated accounting teams or sophisticated software subscriptions, the cumulative effect of these small annual leaks in their tax efficiency becomes a massive force working against wealth accumulation. The cognitive load required to maintain optimal lot selection often leads to inertia, where investors simply stop rebalancing because the math is too complex to perform manually without making errors that could trigger audits or costly penalties. The risk of reporting errors increases exponentially as the number of holdings grows, and a single mistake in identifying which shares were sold can negate any theoretical tax benefits you might have gained from trying to be clever with your timing. This reality suggests that for most viewers building financial literacy, the path to true diversification is not found in buying more individual stocks, but in consolidating into vehicles designed to handle these complexities automatically. By shifting toward broad index strategies or tax-managed funds, you transfer the burden of cost-basis tracking and lot selection from your personal time and attention span to a system that has been optimized for exactly this purpose over decades. This shift does not mean abandoning the discipline of investing. It means recognizing that managing hundreds of individual positions is often more work than simply holding a diversified market proxy while simultaneously reducing your tax liability every single year you remain invested. The goal is to maximize what stays in your account after taxes, and for most people, this requires accepting that true diversification does not require owning 50 separate companies on the open market. It requires owning a slice of the entire economy through vehicles designed to handle the friction of real-world tax rules, so you can focus on growing your wealth rather than managing an accounting department within your own head. The evidence is clear. When you hold dozens of individual stocks in a taxable account, you are creating a fragmented cost-basis landscape that forces investors to realize capital gains incrementally upon selling winners, converting what should be tax-deferred compounding into an immediate tax drag that erodes long-term CAGR. This inefficiency acts as a hidden drain on your portfolio's potential growth rate, often outpacing the fees charged by any mutual fund or ETF you might consider replacing them with. By understanding this dynamic, you can make better decisions about how to structure your taxable account for maximum efficiency over the decades ahead. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.